Gold is the talk of the town. The yellow metal's stunning rise, about $3,000 per ounce in the global market and 1 lakh rupees per 10 gram in India, has made it the topic of everyday conversation. In 2024, gold delivered 20% return compared to the Nifty's 8.7% gain. And in 2025, it has seen the upward momentum continue. From about 78,000 rupees to 1,30,700, the price of gold per 10 gram has risen about 45% in the first 9 months of the year. In fact, since August 2024, the gold price has moved up from about 70,000 levels. That's a rise of about 62% in little over a year. If we go back a little further, the price has been moving up sharply since February 2024 from about 64,000 levels. That's a gain of about 77% in about 20 months. Truly stunning gains. These would be the kind of returns that would satisfy a stock market investor. There is no doubt that the gold bulls have been proven right. But they also want to know if there is further upside and if they can continue to hold on. Will the gold price continue to rise or will it finally take a breather? To figure out the answer, we must first understand the factors that influence the price of gold. But first, please note that this video is for information purposes only. It is not a security recommendation and should not be treated as such. There is no view or opinion on any security covered herein. Number 1. Trade wars. In a nutshell, uncertainty surrounding US President Donald Trump's trade policies has raised the yellow metal's safe haven appeal. Gold has always been a safe haven asset. People flock to gold either when times are tough or when there is uncertainty in financial markets. Recently, uncertainty has increased due to the tariffs from the US. Trump's decision to follow through on his election promise to impose tariffs have raised concerns of a global trade war. The second and third order effects of these tariff policies will only be known over time. Financial markets don't like uncertainty regarding trade. This uncertainty has caused investors to think about the impact on the profits of companies. In response, some investors have begun to take defensive positions in the markets. This involves reducing exposure to stocks and moving some funds to gold. This is because gold prices often rise in terms of financial uncertainty due to its safe haven appeal. 2. Inflation. Now there's inflation to consider. Trump's policies have had the effect of increasing the rate of inflation in the US, at least in the short term. For now, inflation has not spiked too much in the US, but this will remain a concern as long as tariffs remain in place. Gold has always been an effective hedge against inflation throughout history. This is what we are seeing now as well. If US inflation were to rise significantly going forward, then gold will continue to rise in tandem. 3. Geopolitical instability. The Middle East is proving to be too hot to handle for financial markets. The last thing financial markets want is another war in this region. The fallout of Israel's attack on Qatar has only added to this concern. Even in Ukraine, a ceasefire has failed to materialize. Gold has always been seen as a means to preserve wealth in times of political turmoil. During such times, throughout history, people have chosen to hold on to their wealth in physical gold instead of any other asset. This won't change in the foreseeable future. 4. US recession fears. The trade wars triggered by the US government has spooked global markets because the Trump administration is determined to see it through over the long term. The unpleasant second and third order effects of these higher tariffs all over the world are hard to predict. The combination of trade disruption and rising inflation in the US is why fears of a US recession in 2026 has increased recently. Gold typically does well when there is fears of a recession in financial markets. Could the gold price fall? The short answer is yes, it can. When the entire market is talking about a rising price of gold, it is easy to forget that the opposite can also happen. In that case, it would trigger losses for leveraged traders who are long on gold currently. The factors that can cause a fall in the gold price are the same as the ones that are responsible for its rise, only in reverse. Here's how. Inflation in the US falls faster than expected. Some kind of peace agreement comes into effect in the Middle East and or Ukraine. There are no other major geopolitical flare-ups in the world, like Taiwan for example. And the US economy does well in 2026 and recession fears fade away. Now this doesn't mean that all the points discussed here need to be fulfilled for the gold price to fall. Even some of these may be enough to take the wind out of the sails of the bulls. But as things stand now, the bulls have the upper hand. However, investors should carefully watch out for any potential changes to the underlying factors driving up gold. If the changes are sufficient in their significance, then the price of gold will fall. Conclusion. At Equitymaster, we believe in having 5 to 10% of one's portfolio in gold at all times. However, investors should not see gold as a potential substitute for any other asset. It makes sense to hold some precious metals in one's long-term portfolio, but it does not make sense to speculate on short-term price movements. While considering an investment in gold, have a time horizon well beyond 2025 or 2026. Just because prices have gone up recently does not automatically make gold a great investment. Do your due diligence. Happy investing.